Good afternoon, ladies and gentlemen. It's been a while since I've uploaded the videos on chapter 10, and in the meantime you have written a semester test on part 2, but finally we can start with part 3. So part 3 is really important, and the third semester test will probably be on most of part 3. So everything in chapter 11 is very important. There's almost no single item that's not important, so you should read very carefully through this chapter. Fortunately, it's quite an easy read. So I'm going to highlight only a few important issues in the video, but I'm not going to focus on material that you are well capable of studying yourselves. So let's page through the textbook. If you're familiar with the methods that I'm using, so if you have the first page of the textbook of chapter 11 open, you'll see it's an introduction to taxation and tax equity. So it's introductory, so you've seen most of this material, perhaps not in a textbook, but in real life. In terms of taxes, most of this is quite familiar to you. So what should you be able to do after you have studied this chapter? Well, everything. There's a long list of 7 items, and you should know all of that. So let's start at 11.1, sources of finance. Where does the government get its money from? Now you have in the part 1 seen some of the taxations, you've drawn a few graphs, you have listened to the budget speech. So this is not the first time that we talk about taxes, but now we will zoom into taxes a little bit more. The dominant source of finance for the government is obviously taxation, and they get close to 80% of their funds from taxes. But they also have 4 other important sources which you must be able to list, and you must be able to define this. So these words, these expressions are those ones that I can ask in the test or exam, and you have to tell me what is a user charge. It's also called a benefit tax. So the best example is toll that you pay if you use a toll road. Only people that use the toll road and goes through the toll gate pays for using that. Or if you go to the public swimming pool and you pay to enter, that's exactly a user charge. Something similar is administrative fees, which is something like your motor vehicle license. It's a tax, but we call it a license, or your TV license or something like that. It's also if you use your motor vehicle. If you don't own a motor vehicle, you don't have to pay the administrative fees. It's quite similar to user charges. But the government doesn't only tax to get money. They very often, as you know, budget for a deficit, and then they have to borrow the money either from the local market or from abroad. One not so generally known source of government revenue is inflation. So they can use inflation to fund some of their expenses. For example, if they borrow money. If you borrow money, I borrowed money many years ago to buy a house. And in the meantime, the value of the house goes up. Let's say I started at 500,000. Today you cannot buy anything for 500,000 in the property market, but I bought a house for less than that. But I only owe the bank that amount that I started out with. And as inflation increases over time, the value of the house increases in nominal terms, but I still owe the same small amount to the bank. So actually, inflation eats up the debt that I owe to the bank, and the government does exactly the same. The second way that they do that is they don't adjust the tax brackets, so they allow for bracket creep. You might have heard this word before. So they use bracket creep, so my salary increases in nominal terms with inflation. I don't really get more money in real terms, but since I go into the next tax bracket, they tax me at a higher rate and makes money in that way. So 11.2 is on the definition and the classification of taxes, very important concepts. So the first thing is that there's not necessarily a direct connection between the resources transferred to the government and the goods and services that the government supplies. For example, the other day, my son asked me if we have a carbon tax in South Africa. Yes, we do. But the government doesn't necessarily use that money to subsidize clean electricity. They tax carbon, but they put the money in the general kitty, and rather than perhaps using that exact money to take care of the environment. So there's not a direct link. Always. Sometimes there is, but most of the time all the taxes just goes into the big basket, and then they budget for it in different ways. The second big thing is, as you know, taxes are compulsory. Well, why are taxes not voluntary? I mean, we are all good citizens, right? So if the government just asks us to pay taxes, then they should get enough money. No, definitely not. It's like TV licenses, and most people don't pay a TV license because it's not enforced. Even though it's compulsory, it's not enforced. But if you try to get away with SARS without paying taxes, especially if you get a lot of money, then they will quickly get hold of you. The third thing is that the government fortunately doesn't have unlimited powers. So the power of the government is regulated by the Constitution. They cannot just levy a tax. That's why the budget speech is read in Parliament and it's approved by Parliament. It's not just a speech, it's actually a proposal to Parliament, and then Parliament has to approve and the President has to sign off on the budget. The classification used, which you have learned about in parts 1 and in part 2, parts 1 and 2 is the classification of our tax system follows that of the International Monetary Fund, the IMF's Government Finance Statistics Manual. So we don't do things in a specific South African way. We use an international standard for all our taxes. So you've seen all of this. You know the graphs, you know the different types of taxes, the percentages, and so on. So you should have a good idea about how the tax structure of South Africa looks. So what is a tax base and what is a tax rate? That's important. It sounds so silly, but I'm very often see students don't know the difference in the test. So the book speaks of 3 general tax bases. Income, that is what can be taxed. Income can be taxed, your wealth can be taxed, or consumption can be taxed. So then there's a 4th one as well. So income is the first tax base. So we have personal income tax and we have corporate income tax. So the income that we as workers earn is taxed at a certain rate depending on how much the income is. So we have a proportional income tax system. But the government can also tax wealth. For example, if you pass away one day, then you have an estate, which is wealth, and then, or you have capital, and then the government can tax your wealth. Capital gains tax is also a form of a wealth tax, because if your capital increases in value, then they tax the increase in the value, and the base is wealth. The third base is consumption. So if you go to the store and you pay VAT on whatever you buy, that is a tax on consumption. And then we say that the base of tax is consumption. But there's a fourth base, namely a person, him or herself. If every person has to pay a specific tax, not depending on his or her income, wealth, or consumption, then it could be considered as a tax on a person. We don't really have taxes on persons, but you can consider a universal income grant as a subsidy on persons, because if everybody gets a grant in the universal way as we had it in the previous chapter, then you can think of as a universal subsidy, because it's not based on income, wealth, or consumption if it's universal. Then we have to distinguish between flows and stocks. So you can see that income and consumption of flows, so income tax and consumption tax is a tax on a flow, while the wealth tax is a tax on a stock of wealth. Then we have obviously the proportional, progressive and regressive taxes, and we use the average tax rate to determine whether a tax is proportional. If everybody in the country pays the same average tax rate, let's say everybody pays 20% of their income, whatever the income is, then that would be a proportional tax if the average rate is the same. But if your income increases and then the rate that you pay, the total tax divided by your total income, increases, which is the case in South Africa, then we have a progressive tax. If it would be the other way around and you pay less and less and less as your income increases, which one wouldn't think is possible with an income tax, then it would be a regressive tax. But if you look at the box 11.1, you should really carefully go through that example, and then you will see that the consumption taxes that we have could very well be regressive, because everybody pays the same rate, but not everybody consumes the same amount of goods. So as a proportion of our income, the VAT is certainly a regressive tax. So make sure that you understand box 11.1. Okay, so much for the text in the textbook. I think you can highlight your own textbook in a way that you can understand this better. In the next video on chapter 11, I will go through tax incidence analysis using different graphs. The microeconomics students that were with me last year will know this very well, but many of you didn't take Economics 224, so I will go over all the tax incidence graphs in the next video.